right now the US is on this very unsustainable fiscal path where they're running very, very large deficits. And historically, the way you deal with that is you kind of monetize it. If you're an emerging market and you owe debt that you can't print, like if you're Argentina and you owe dollars, you just kind of have to default or ask for like a restructuring. Whereas if the liabilities are in your own currency, like if you're America with dollars, if you're Japan with yen, you essentially print the difference, but that leads to inflation. You're inflating away part of the debt. And right now they're kind of in that counter push where they're kind of trying to get the wheels back on the cart. They're kind of trying to say, this is sustainable. We're going to get back to like financial discipline.
The U.S. Treasury recently published a chart that Lyn Alden recently shared on Twitter. The chart shows the growth of the U.S. debt as a proportion of GDP and charges that no improvements will be made to the country's existing fiscal condition, resulting in an unstoppable increase in debt. However, in reality, it is anticipated to be messier and lead to a duke and rapid expansion of nominal GDP. Austerity hasn't historically worked effectively after debt to GDP has reached more than 100%, according to Lyn Alden, a seasoned investor and analyst on the subject. Due to how heavily GDP depends on those deficits, reducing deficits also has a negative impact on GDP. It would therefore be exceedingly unusual at this point for there to be no considerable currency devaluation component. In this video, we'll delve deeper into the video and examine Alden's opinions on the Fed's stances and how they affect the global economy. As you watch the video and find it entertaining, don't forget to subscribe, like it, and leave your comments in the comments section below.
That's kind of like no recessions, no wars, no XYZ. That's just kind of like business as usual if nothing's fixed. Of course, it can't actually end up looking like that because you'd run out of base dollars to support that. You'd eventually would have to print the difference, and therefore you'd have a rapid growth in nominal GDP, which would mostly be the inflation component, and it would be a lot messier than that in real life, which is kind of why I kind of picked fun at them for publishing that chart.
Yeah.
I've done actually similar analysis to what Parker just described, which is, kind of looking at ratios of either money supply, like broad money supply to base money, or total debt to base money. And so you can plot them over time. And we did hit a peak back in around the global financial crisis. It was something like 60 to 1. I think his chart showed 52 trillion to less than a trillion. If you kind of do the numbers, it was like 60 or 65 to 1 ratio. And the last time we hit a super high ratio was actually 1929, like the early 1930s, before there was all sorts of like monetization then. And you kind of had this big echo happen ever since the global financial crisis, where we've been increasing the monetary base to try to catch up with that broader setup. And the 13 trillion I mentioned was specifically the offshore dollar-denominated debt. So that's like debt that would be owed by entities, either governments or corporations in places like Turkey, Brazil, China, countries on the world that use dollars. And the challenging thing here is that both assets and liabilities in many cases are denominated in dollars. So in the United States, for example, we have 100 or 200 trillion dollars in total assets. That includes real estate, stocks, bonds, things like that. Even if you just factor out the debt, you have basically real estate and stocks. That's on a pretty small monetary base. And then you have all those liabilities. And so it's kind of this that's why you get these liquidity crunches when they try to do things like pull dollars out of the system, or if there's any sort of shock to income while all of these, assets and liabilities are highly levered compared to the monetary base. And you see a similar effect when you look globally. And essentially what we're seeing now with that chart you brought up is just that right now the US is on this very unsustainable fiscal path where they're running very, very large deficits. And historically, the way you deal with that is you kind of monetize it. If you're an emerging market and you owe debt that you can't print, like if you're Argentina and you owe dollars, you just kind of have to default or ask for like a restructuring. Whereas if the liabilities are in your own currency, like if you're America with dollars, if you're Japan with yen, you essentially print the difference, but that leads to inflation. You're inflating away part of the debt. And right now they're kind of in that counter push where they're kind of trying to get the wheels back on the cart. They're kind of trying to say, this is sustainable. We're going to get back to like financial discipline. And it's one of those things. If you do the math and you do somehow conclude that they can do it, if you think, okay, they can return to structurally positive real yields, they can get this under control. They're going to do all sorts of fiscal adjustments to get the debt under control. They're going to start paying it down. Then that's a good case to buy and own dollars long term. On the other hand, if you do the math and you kind of realize that this is almost certainly unsustainable, and that almost any attempts that they try to change the system will probably cause a problem elsewhere in the system, and continue the kind of the perpetual debt increase and more rounds of quantitative easing and long stretches of negative real yields on all these various bank accounts and debt instruments, then that's a case to buy, like sound money. Historically that could have been gold. Of course, this is a Bitcoin show. Bitcoin is the fastest horse in town, better in many ways compared to gold. And so essentially that's kind of the case to buy those harder monies if you view them as more sound than what you're probably going to get with the U.S. financial system, let alone when you do kind of a similar analysis on other countries around the world and their debt issues.
The way that money is distributed may have a big influence on the economy as well, since it can cause imbalances in the system and set the stage for future financial crises. As Lyn points out, citizens in emerging nations frequently deal with challenges related to continual currency depreciation and must consider how to safeguard their money. It might be challenging to decide what to hold one's money in this situation, but some potential possibilities include solid currencies like the US dollar or gold, or real assets like property. However, each choice has advantages and disadvantages, and ultimately, it boils down to personal choices and circumstances. What are your thoughts on Alden's analysis of the Treasury charts? Please feel free to share your thoughts in the comment area. Be sure to subscribe, like, and enable alerts on the video as well. I appreciate you guys taking the time to watch our video. We'll see you on the next one.